I don't, it's not just Trump. I mean, Trump isn't helping. In fact, on the margin, he's hurting. But I think that the trends would have continued regardless of the outcome of the last election. I think, a big catalyst, although not the cause, because it would have happened anyway. But I think when Biden sanctioned Russia, and I said this at the time, that those sanctions were sending a powerful message to the whole world to get rid of dollars and not to use the US dollar and US Treasuries as a reserve, because we could, yank them out from under you whenever we want. And so that's not a good position to be in. It's like, tying a rope around your neck, throwing the other end over a tree limb and hoping the guy that catches it doesn't pull it, right? So I thought that would cause money to come out. But I think what's even more significant is a long overdue realization that the U.S. cannot possibly repay its debt, honestly. That the national debt, which is now $38 trillion, and of course that's just the bonded debt, not with all the unfunded liabilities, but the treasuries that a lot of foreign central banks own, there's no way the U.S. government can repay that debt in money that isn't dramatically debased, meaning that the U.S. government will not be able to raise sufficient tax revenue to make good on its obligations. The Fed is going to have to print the money. And also, we have so much debt now that we can't even afford to pay a rate of interest that would be commensurate to the loss of purchasing power that you might experience holding U.S. debt to maturity. And, that's why Donald Trump is beating up the Fed to cut rates. In fact, that's why the Fed is cutting rates, even though inflation is well north of their, bogus 2% target and headed higher, right? They're cutting rates when they should be hiking rates. And it's mainly because we can't afford the rates that we have now, let alone the rates that would be required to restore inflation to 2%, right? So we're cutting rates, but we're letting our creditors know that if you hold dollars or treasuries, you're going to lose. We are going to debase what you're holding, and we're not going to pay you a rate of interest that's anywhere near close to compensating you for what you're going to lose to inflation. And so I think given that, the world has made a decision to get out of dollars and get out of treasuries. Why hold U.S. treasuries and earn a 3 or 4% yield if inflation in the U.S. is going to be higher than that? And of course, if the U.S. dollar is going to lose more than that in terms of purchasing power on an annual basis. And so rather than holding dollars and investing them in treasuries, they're going to hold gold. I mean, that's it. I mean, we've basically put them in that position. And I think what Donald Trump has done to really, sound the alarm and, give these guys, a kick in the ass as far as getting this done is, the Republicans and Trump, campaigned on fiscal responsibility, on, we've got to rein in the Biden deficits. We had all this inflation because of deficit spending under Biden and the Inflation Reduction Act. And so we need to get in there and we need to cut spending. And, they had Elon Musk, we're going to come in with Doge, the Department of Government Efficiency, and we're going to slash and burn. We're going to be like Milei in Argentina. We're going to take a chainsaw to government, right? So, these promises were made and none of them were kept. No, I don't think gold is signaling growth. I think it's signaling inflation. Okay. And so I think you're going to see the weakness in the dollar against other fiat currencies. I mean, clearly, when gold is at 4,000 and it was at 2,000 2 years ago, the dollar's lost half of its purchasing power in terms of how much gold you can buy with your dollar. So the dollar is losing value against real money right now, but so are the pound and the euro and the yen and all these other currencies. But I do think that you're going to start to see the dollar losing a lot more value relative to its fiat counterparts, either before the end of this year or next year. And that's going to accelerate the increase in the price of gold in dollar terms. But I think it's already giving you a forewarning that that's going to happen. I think gold is rising as a reflection of a loss of confidence in the dollar, because I think the main reason that gold is being accumulated is because central banks have lost confidence in the dollar and in the fiscal responsibility of the U.S. government, or the credibility of the Federal Reserve. So you're seeing it first in gold. I think you'll next see it in the dollar, and then I think you'll see it after that in the Treasury market, where you'll start to see a big drop in bond prices and a rise in long-term yields, despite the fact that the Fed is going to be reducing short-term rates. And I think that is going to be the catalyst for a return to quantitative easing, because I think the Fed is going to try to lower long-term interest rates through its open market operations, where it needs to print money to buy the bonds that the rest of the world is selling. And so that, I think, will be another catalyst to drive gold to even higher levels, because that's just massive inflation. And, the last couple of times we tried a QE, inflation, at least the way the government purports to measure it, was below 2%. So the government was able to justify QE by saying, look, inflation is below target. And so we could do this because the goal is to get inflation higher to reach our target. And so, we're going to accomplish that with QE. But if inflation is already well above 2%, what is the excuse for creating more inflation? How do you justify QE when inflation is 4 or 5%?
Well, that's
the way the
simple,
government
Peter.
measures it.
That's simple. The Fed just moves its inflation target to 3% unofficially, and then you've got more QE to be justified.
Well, but I don't think they could do that, because just moving it to 3%, once you move the goalpost once, right? Well, now you've already broken trust, because if you can move it to 3, you can move it to 4. But even moving it to 3, is a big game changer, because that means a 50% increase in annual inflation. So, what does that do to the present value of gold if inflation is going to be 50% higher from now until the end of time? But of course, they're not going to achieve 3, because if they give up 2 and they move to 3, well, then they're going to give up 3. They've already proven that their target is BS when they're above it. They don't have the monetary cojones to do what it takes to bring inflation down to 2%. Well, then why would they have it to bring it down to 3% or 4%? So I think, once they move it, they're done, which is why they probably won't. I don't know that they're officially ever going to say that they have a target of 3. I think they're going to keep a target of 2, but they're just never going to hit it. And I thought it was really ridiculous. In the last FOMC meeting, somebody actually asked Powell about about his forecast, because he pointed out, hey, 2 years ago, you predicted that in 2 years inflation would be 2%. And now it's 2 years later and it's way above 2%.